la famille.
Cool. So here we're going to talk about the relationship between you and investors. So there are going to be a lot of things that answer the questions we were just talking about. The first thing to understand is something that Usama has been talking about also, is to understand the difference between good and bad investors. So as a meta view of it, it's just people that you will enjoy spending time with over the long term. What I say to founders is that they want to partner with people that that want to build the same companies they want to build. If you want to take a lot of risk and build a business that makes 100 million in revenue in the future, you need to share that journey with people that are okay with the risk you want to take. If you partner with if you want to build a company that is going to grow more slowly, going to be a local leader, then you should team up with investors that also want that. Otherwise, on the long term, and you'll see that the relationship goes south and it becomes a terrible thing for you and for the investor. So a couple of things where you will see whether investors are good or bad. First is whether they share the enthusiasm that you have for the project you're building. Second is whether they help you build up the clarity and the vision we were talking about in the previous presentation. Are they helping you refine the next 12 months? Are they helping you refine the long-term vision? Also, you'll see that good investors are usually very clear on what they expect. They don't make you wait. They not saying that if you're doing more revenue, we will invest. They're going to say, okay, I love what you're doing. I'm not sure about retention rate for this type of customer or the upsell you could have. If you prove that, I'm in. They're not going to put it on like vague metrics that you have to target. And the last thing, which is probably the most important, is good investors are doing the work and they're very cautious of founders' time. We've come to realize with Usama, Alice, Matthias, and the others that nothing is more precious than the time of a founder. They have a business to build, and having investors that request business plans and lengthy presentations and all these things before being really interested in investing is a sign of the worst investors. So you need, when assessing whether they're good or not, you need to see whether they're working. And working means they are very interested in what you're doing. They're doing reference calls or trying to understand what your product is to the other. There has been a lot of improvements. Often there is a discussion whether analysts or juniors in funds are good people to talk to. And the European ecosystem or ecosystem outside of Silicon Valley have developed in a very different way than in the US. In the US, there is such thing as FOMO, and everyone remembers the story of Sequoia not being able to invest in Facebook because Sequoia had screwed up with the previous company of Sean Parker, which was Napster. This never let them invest in Facebook, and they were convinced it was an amazing business. They probably lost billions and billions on that one. And since then, everyone is really scared about the first interaction between a fund and a company. And so in the US, it's very typical that the first meeting will be a partner to be sure that the relationship goes fine. The second, third might be with people below the partner that are actually going to do the work to see whether the business is good. In Europe or in the rest of the world, usually you get targeted by juniors first, and don't be judgmental about the fund because they do it. Axel, for example, is often reaching out with younger people in the fund, while other funds reach out with partners. Juniors are sometimes really good. You just need to understand who they are and what their incentives are. The good thing is that they have a lot of time with partners. When you're going to meet a fund, you're probably going to have 30 minutes, maybe 45, maybe 1 hour with a partner. That's not a lot for a complicated business. Juniors are going to see the partners every day for weeks. They can really do the work on your deal to convince their partner that they need to take another meeting. And we've seen it many, many times. So I'm going to talk about 3 stages. And 3 stages, I mean how you need to interact with investors before the fundraising process starts, during the fundraising process, and after the fundraising process. The most tricky part is probably before. Investors are paid to talk to startups, and they need to reach out to the entire market to see what exists. And often, founders feel privileged because some VC is contacting them and wants to talk. It's very important that at that stage, you need to push back and tell to investors that you are the one deciding when you're going to be raising fund and not the opposite. So typical good answer for a fund would be, hello, I'm very pleased to see that you have an interest in my company. These days, I'm really focused on reaching this metric and I'm not currently fundraising, but it might be nice to take a 20-minute call Wednesday morning at 8 a.m. That way you build a fundraising process. You do this only with funds that you know have good reputation. You don't need to talk to everyone. Just say yes to the people you might be willing to work with in the future. And when you do this 20-minute call with someone, don't ask their questions. You need to be the one that is telling the story. Like we said in the pitch deck, you need to choose one subject. You need to talk about your team, your vision, and your product. Don't talk about your metrics. And if you want to build credibility and build trust, you can say that currently you're working on one thing that is very important, which is, I don't know, like getting another 20 clients on the SMB segment before the end of the quarter. And if you do so, next time you talk to them at the end of the quarter and you've actually done these figures, they will say, okay, this founder is actually really good. He does what he says. But you need to control the timing and you need to make investor work for you, not the other way around. By making investors work for you, I mean, they need to be prepared to win the deal when you're going to be on the market. And if they want to show that they're valuable, they need to do things. And you can potentially ask for intros to other founders in their portfolio, to potential clients, or even to operators in some of their portfolio companies that might have expertise on things that you're currently exploring, like, I don't know, SEO, direct sales, or even hiring. The other thing that you need to do before actually fundraising is building the brand of your startup on the fundraising market. If you make sure that everyone knows that your company is doing well and that you're going to be fundraising in the future, it's going to spread like wildfire. It's very important. It's like the first few lines that you send attached to the deck. This is the little feeling of the market about what you're doing. Investors will be willing to work much more if they think that you're a good business. So before, understand that your incentives are not aligned at all. They want to know you as many times as early as possible to just get more data points on how you're doing. You want to build trust, but push them away and decide when you start fundraising. And the most common mistake that we see is an entrepreneur receiving an inbound call from an investor. He knows everything I just told you. The investor is super enthusiastic about the business, wants to dig deeper, and the entrepreneur is like, oh, cool, I might actually fundraise. Then the investor does more work. Other investors start to hear that the market is maybe going away in the next minute, so they also contact you, and then you're fundraising. This is the worst thing that happened to you, because you're probably not ready yet, because you don't have the deck, the financial plan, but you most oftenly you don't have the right metrics to raise. So stay in control, stay far away. The second part is during the process. The process is as important as the story you're telling. And there is the number one reason investors are going to be excited about your deal is because they understand that other investors are excited about your deal. It's a bit sad, but it's the truth of the market. So to maximize the chances of success, you need to talk to investors in parallel, and you need to market your process. By this, I mean that you can in a subtle way, you can say that you're talking to a lot of people. You can say that you've got an intro from like an incredible angel to the fund that also invested in his company. And you need to build up the tension and the fear of missing out on everyone else. You need to enter these discussions, and this is actually true for the 3 stages of the process, understanding that you are not the one that is selling yourself to investors. You are selling yourself, but they are also selling themselves. It's something that is not understood by most founders, but VCs need to fight to get into the best deals. That's why they do so much content marketing. That's why they do so much advertising of their portfolio. That's why they hire people to do operational work for the companies they invested in. Investors want to fight to get in the best deals. And they're often even probably a bit jealous of the success of entrepreneurs they invest in. So when you talk to them, remember, you talk to them like you are talking to friends, you are talking to an equal person. And you can also make them work. What I mean by work in this case is they need to be researching your company, researching your industry, researching your clients. You are not the one that needs to answer questions and write pages and pages and pages for every request of investors. The best ones are going to be very, very careful about your time. They're going to do most of the work themselves. And when they need an input, they're going to ask for you. After to still be careful about the relationship you have with investors. There are many reasons for this. One is that you want to choose the right partner at the company. And the second one is that you want to safeguard the relationship you're going to have with the funds for the rest of the years. You don't want to negotiate too hard with them and start in a relationship that is not good. They're going to make you pay for it in the future. So always take every investor as an individual person, not as a firm. It's with the individual that you're going to work over the next 10 years. Always take each investor as a separate person and never say no to funds or people before you actually have signed everything and received the money. It's very current that we see someone being like super excited about one fund saying yes, then they actually say no. They say to everyone else that they don't need to go further in the process until the first term sheet drops and the founders need to build everything again because the momentum has been lost. So never say no to others. Wait until the money is in the bank and build pressure until you actually sign a deal. The due diligence is something that founders or blog posts talk about a lot, and it's something that almost never happens. I don't exactly know why it's such an important topic while being so non-existent in reality. And my guess is that VC funds need to say to their own investors that they're doing super heavy due diligence to get money from them, when in reality, they don't really care about due diligence, nor they have the time to do it. So once you have a term sheet, usually what happens is a VC just checks whether what you said is true or false. They're not going to go in LC detail. They're just going to check that revenue does exist. You do have employees. You do have clients. And there is like no obvious legal problem. So don't focus too much on building something for due diligence.
All right. Thank you very much, Balthazar. You're perfectly on time. You can stop sharing your screen and we can take maybe some questions. We take 3 minutes and then we switch to the third part of this workshop, the concrete part, the pitch part. I mean, when you are starting the conversation. So feel free to ask your questions right now. We're taking it. And I hope you're still here, full of energy and will to learn and will to connect. Yes, go for it.
A few times I've seen questions about raising in another country. And I think it's probably a mistake. If you read TechCrunch, like you're probably depressed and you think it's super easy to raise in the Valley. This is not exactly true. It's as difficult to raise in the US than it is here. And when they raise 10 million, they probably spend much more time, much more money doing the same thing that you do here. In other markets, it's especially at the early stage. If you need to build a trust relationship with someone, it's probably easier with someone that is like you, probably from the same country, that's someone that has never seen the type of founder you are in his ecosystem. And I can tell you that French founders have a lot of problems raising in the US because they're typically introverts, they're not overselling, and they're probably highly technical. And these are not the Valley stereotype. And so they have a much better time raising in Europe. And once they have traction and it's actually obvious that what they're doing is good and they're good CEOs, they get to raise in another country.
Okay, Franz has a question.
Although one important thing is COVID changes a lot of things. And thanks to Zoom, we see investors from all around the world invest everywhere. And if you're the type of founder that knows how to present yourself in a very elegant manner, probably leverage it to get the best out of what the world has to offer.
Franz has a question. Canada has a startup visa program, and we want to start here and then make it to Canada. What would investors in Germany think if your plan is to leave to Canada?
I think investors are understanding. If the story is coherent and you're building something and you're explaining clearly why you're moving to Canada, I think it works fine. If you're telling them you want to go to Canada because life is cool there and you actually want big spaces, that's probably not good for the business. If you're telling them it's the closest way to the US market, I can hire engineers there at half the price in Germany, and I get a lot of support from XYZ, then they're going to be super supportive of you moving there.
Akshay is asking, have you helped startup from India to help fundraising?
Yes, actually we helped one recently. It's an Indian startup, 30 people based in Bangalore. The CEO moved to Germany and his company is incorporated in the US. And we helped him raise a seed round, and we're now helping him raise a Series A round.
This is very focused on VC investment. What about other options to raise funds? Can you do a mixed? Does the type of business you do help determine that? This is a great
if you're trying to build,
thank you.
If you're trying to build a scalable business, at the early stage, the only thing that is available to you is equity investment. And these equity investment can be made by business angels or by funds. And these are the only people that can do it. Once you grow to a much larger scale, you can also use debt, but banks and people that issue debt are much more conservative on the downside, and they're going to ask for much more.
All right. What about post-Brexit UK?
We think the UK is still going to be a good place to build companies and a great place to raise funds.
What if company has no technical barrier but network effect instead?
I think these companies can be really good. It means that the product is going to become better and better the more users you have. And this is actually going to be a huge barrier to entry afterwards. I think today there are a lot of people that could build Instagram as a product, but if you don't have the users, it's actually a shitty
Glenn
product.
is asking, are financiers that help you raise funds trustworthy?
It's always a tricky question. You get people that put their own money and then help you raise a lot of money. And some of them are the best investors in the world. They know that they have the social proof to help you. And then you have the people that have no skin in the game. And these are a bit more edgy. And seed investors that ask for 40% of the shares are not living in reality. They are putting a heavy burden on the company's future.
What about African startup operating and based in Africa, eventually incorporated in Europe or in the US? How about raising funds with European investors?
It's more difficult to raise funds when you're telling a story that people don't understand, and most investors don't understand the story you're telling when it comes to Africa because of the infrastructure difference between countries. They don't understand the mentality. They don't understand what how peer-to-peer payments work. They don't understand the roles of telecoms. So it's going to be more difficult, but it's possible.
What are your thoughts on seed investors asking for high shares, 40%?
Yeah, I think it's not doing a favor to the businesses, and seed investors should stay below 25%.
So we've been bootstrapping for 5 years. Now we want to raise funds. How can the family help?
Oh, nice. The family can help you understand the mindset of going from a bootstrap company to a VC-backed company. And this move is actually important. It means you need to understand how to allocate money to optimize for growth rather than to optimize for profitability. And it's not a move that you're doing for only 1 year or 1 year and a half. It's something that is probably going to be defining for the life of your company. And I know a lot of people that bootstrap their businesses to a couple millions in revenue, always did it in a clear way. At one point, they want to enter the US market, for example. And hiring 5 people there to start the business is going to cost them 1 million a year. They could do it with their bootstrapped company, but it would take a lot of time and it would be a lot of risk. So they raise a couple millions, which helps them actually launch there. And these are the stories we can really help with, like both on understanding the mindset and then on fundraising.
What is a typical share an investor wants for seed or Series A funding? Is asking Corina.
I would say between 15 and 25%.
A very good question from Samir. What do you suggest to do when you are already working with bad investors? They are in your capital. Are the new investors likely to buy out the bad ones?
So unfortunately, it's very, very complicated.
And that's why you need to work on your first fundraising.
Kind of change our mind. Yeah, you need to work on it before fundraising, and you also need to safeguard your relationship after fundraising. Never get in ugly fights with investors. They have a portfolio of assets, so they can afford to lose one. You have only one asset, and you cannot afford to lose it. So keep the relationship with your investors as at the highest levels. And if you're really successful, they're going to be fine. If you're less successful, try to get them to get some money out at every round, so they become a bit less annoying to the success of your company.
All right, I think we should switch. I cannot take all of the questions. Maybe you can answer in the chat directly, Balthazar, because we haven't been taking all of the questions. There are so many that are super interesting, because now we are about to start the third part, okay, with Matthias. Balthazar, you stay with us, huh? In the chat.
Yes. See you.
Thank you very much. See you.
Que la famille.